This is Under One Roof MTL on CJD 800. My name is Robin Flynn, joined as always by Fred Pichette and Martin Spalding of Fred and Martin Mortgages. Good afternoon, Fred.
Good afternoon, Robin.
Good afternoon, Martin.
Hey, Robin. Happy Sunday.
Happy Sunday to you, too. Also joined by LJ Aguinaga of LJ Realties. Hey, LJ.
How you doing?
Very good. The sun is shining, and I got a parking spot right out front.
That's what's up.
So rarely happens. Best day ever. Super happy. Let's start with our trivia question of the week before we dive into some of the news this week. Brought to you by Felix and Norton Cookies. You can visit their store at the Blue Haven Shopping Center, 3705 St. John's Boulevard in DDO. If you think you know it, 514-790-0800. Include your name. If you're the first one through, you will win cookies from Felix and Norton. Our question this week: what is the minimum amount of equity required to refinance your mortgage in Canada?
Not the maximum, right?
Not the maximum. Is there a maximum?
Yes, absolutely.
Yes.
Okay. What is the minimum amount of equity required to refinance your mortgage in Canada? 514-790-0800. Guys, when we spoke last Sunday, we were a day away from the federal election. We weren't sure what was going to happen. We now know that the Liberals and Mark Carney have formed a minority government. They have big plans, big stimulus spending. What do we think this is going to do for the Bank of Canada? Will it have an impact on what they do with interest rates, Fred?
Well, the good news is Mark Carney runs the Bank of Canada in the past.
Yes.
Which is, if someone knows how to run it, it's him.
Yes.
And he's a very good economist. Like, I'm kind of, of confidence that he'll loose up maybe the rules a little bit.
But he's
and
working
help.
with a team now, right? People who
course.
want to get things done. They need the NDP who hold the balance of power with their 7 seats if they want to get anything done, right?
Or they need the block.
Or the bloc, yes. I think I might rather play with the NDP. That feels a little bit easier.
He already openly stated that he is not looking to form any sort of coalition. That the answer was, why would I need them? So I don't think he's going to do much outreaching to them, to be honest.
Okay. What do you think that this is going to affect interest rates? Because, I mean, even just this week, he announced that he's expanding dental care to all Canadians. Like, it seems like he's ready to spend.
I think that really, I guess my hope is that we can take a much more financially savvy approach and that we're conscious of the spending that we're going to be doing. And therefore, in a perfect world, whether I believe it'll happen or not, them and the Conservatives can get on the same page on some of the financial policy to try and take us in the right direction and try and limit the debt that keeps on growing day by day, obviously, and make sure that we can really build a stronger, more powerful Canada that we can be proud of again and take the right steps forward.
Martin, what was your reaction? Are you feeling good this week?
Well, what's really funny is that doesn't it feel like the election was 2 years ago? It's not. It's going to be a week tomorrow that he was elected. And for a non-politician, he sure seems to be acting like a politician very quickly. And I think that the big news also is he's heading down to Washington on Tuesday
Yep.
To meet with Mr. Trump. So do you think the eyes of Canada will be on him on Tuesday? And obviously the focus will be tariffs, trade, and the broader relationship between our two countries. So what kind of impact is that going to have? Well, we'll see what kind of meeting he has with Mr. Trump. And we'll see if we can get a little bit of stability back into our economy. And if there's a little bit of stability that comes back into our economy, I think that'll bode well for interest rates going forward.
And when you say bode well, do you mean that means they'll stand pat? Because if the economy is stable, presumably the interest rates wouldn't continue going down or up, right?
Well, because it's funny. Fred and I were looking at things this week, and lo and behold, fixed rates are creeping up, and the variable rate discount is shrinking.
Oh,
So so you sort of sit back and you go, okay, wait a minute. I thought the Bank of Canada was cutting interest rates, which should be pulling down the fixed rates and should be offering better discounts on the variable rates. But lo and behold, last week we saw everything creeping back up. So when I say stability, are we going in this direction or are we going in that direction? And so right now, obviously the Liberals are going to put a stimulus package into play. But will that be enough stimulus to help us avoid what they're predicting is going to be a mild recession? So the thing is that Mr. Trump changes his mind on a day-to-day basis, and everyone's trying to adjust as to okay, today it's 10%. Tomorrow it's 25%. And hopefully that when Mr. Carney comes into his office, so there'll be a sort of a meeting of the minds where each country needs each other. As much as Trump says he doesn't need Canada, we have a ton of stuff that the Americans need, and they have a ton of stuff that we need. And we have the largest unprotected border between the two countries. So can't we just get along?
Can't we just get along?
Can we just get along?
That's the question of the year, my friend. This was interesting too. Non-bank mortgage lenders. So we've talked about this on the show extensively. They've continued to see steady growth towards the end of 2024. So what do we think is going to happen here, Fred? I know you're very familiar with preparing, alternative lender, B lender mortgages for your clients. Is this something that's becoming more popular?
Well, yeah, it is very popular right now. We got a call, Martin and I, we got calls every week for people like, oh, I got refused by my banks. Could you help me out? And most of the time is because my credit is weak. I don't declare enough income. And obviously, if the economy is struggle a little bit, people are struggling as well. And sadly, you need to qualify based on income.
Yeah.
But the good news, there's solution out there. We call them the alternative lenders, and also private lenders. Private lenders is not something that I often recommend, but sometimes if it's for a short period of time, it could be a good fit. But alternative lender really could help people to refinance even though they have a weak credit or not enough income declare.
LJ, from your standpoint, does it matter if somebody is approved with an A lender or a B lender for you, as long as they have financing? That's all that really matters?
100%. And even if they're willing to go to a B lender, shows me that they're that much more serious to a certain extent, that they're willing to make certain sacrifices to make the deal happen. So if they've explored those options and they're ready to go on that front, then awesome.
Is that something you recommend to your clients if they're struggling credit-wise or income-wise? You say, go call Fred and Martin, figure it out?
100%. The reality is that waiting until you clear up your record, we'll call it, so that you're in a position to purchase can sometimes take 1 to 3 years.
Mm-hmm.
The average appreciation, even if we just go on basic, classic 3% annual appreciation in our market, it makes that the goalposts keep moving on you so quickly year after year. And if we happen to go into one of those crazy years where it's a 10, 20, 15% appreciation, then you're playing this game that makes it very difficult to catch up.
Yeah, this is, it exactly what happened to me, right? In August 2019 is when we bought our house. We didn't have great credit. We were, declined from an A lender, and we had to make that decision. Do we take some time to repair our credit, or do we go with a B lender and see what happens? And I'm so glad we went with a B lender, because then COVID happened and everything went crazy. So
you're the best example.
Exactly.
And there's nothing wrong to go with an alternative lender or B lender.
Yep.
The interest rate is, let's say, 1.5 to 2% more than a regular bank. There's a lender fees as well. But at the end of the day, they're there to fill up a need.
And gets you into your house, which is
It's
the
also,
ultimate
Robin,
goal.
it also has to be part of a strategy. So if you're going to go with a B lender, you want to do that for 12 to 24 months.
Yes.
And within those 12 to 24 months, you need to address the things that probably stopped you from getting an A mortgage. So if it's your credit, whether it's your declared income, if you're an independent worker, whatever it may be, use those 12 to 24 months to rehab your situation, so that, because B lenders tend to sign you for 12 months to 24 months. These are not long-term mortgages. And so at the end of those 12 months, those 24 months, you want to be in a position so that Fred and I can take you towards an A lender.
Yep, that's the ultimate goal, right? You don't want to be with a B lender forever.
Absolutely. Yeah, you don't want to be there forever, because there's no point. So you know what? Take the time, so build out your strategy and be disciplined about it. And at the end of those 12 or 24 months, you'll be able to go towards an A lender, where you'll benefit from lower interest rates, longer amortization period, and so on and so forth.
Speaking of interest rates, we have a question from JB in Pierrefonds about interest rates. We'll get to that after we check traffic. By the way, if you're not sure if now's the right time, if you're not sure if you qualify for an A mortgage or a B mortgage, you're not sure if you should be shopping around for a home now, can help you figure out what to do. LJ, give him a call, 514-500-4040. He'll help you figure out if now's the right time to purchase a home.
This is the Mortgage Minute.
What are GDS and TDS ratios? This is your Mortgage Minute. GDS and TDS are two simple ways lenders figure out if you can afford a mortgage. GDS, gross debt service, looks at how much of your income goes towards your basic housing costs. things like your mortgage, property taxes, heating, and condo fees. TDS, Total Debt Service, goes a step further and includes all your other debts, like credit cards or car payments. Most banks want to see your GDS under 39% and your TDS under 44%. If you're over those limits, it's not a deal breaker. There are still options, especially with alternative lenders.
This is Under One Roof MTL on CJD 800. That's Martin, that's Fred, that's LJ. I'm Robin. We're with you until 1 p.m. GDS and TDS and TFSA and RRSP, and we use so many acronyms on this show. So I'm glad that you decided, Martin, to do this for your Mortgage Minute this week, because it can get really confusing to understand the difference between GDS and TDS and why they have different ratios. Like 39%, I think you said, and 44%. That seems like very, very arbitrary numbers.
Well, I think there are two affordability ratios that lenders use to assess if a borrower can realistically manage their mortgage. So if you look at the formulas, so GDS, gross debt service, is, as mentioned, mortgage payment plus property taxes plus heating plus 50% of your condo fees if it's a condo, divided by your gross monthly income times 100. So if that lands under 39% of your gross monthly income, check. The A lender will be very happy with that. TDS is total debt service. So on top of your housing costs, as just mentioned above, they also look at your monthly obligations. So things like car payments, credit cards, do you have a student loan? And they divide that again by your gross monthly income times 100. So if that math gives an A lender 44% of your gross monthly income, then you get your second check. So that's how they build out the qualification process. And what a lot of people have to realize, it's also includes, so the qualification process and these ratios include the stress tests. And I'll hand it off to Fred because he loves to talk about the stress test.
Well, what is the stress test? The stress test is an additional 2% that you need to qualify on. Let's say the 5 years fixed rate is at 3.99, you will have to qualify on 5.99. And that's and then obviously, as Martin says, the maximum ratio is 39.44. Some lenders, if your credit is, let's say, below 700, below 680, they will reduce the qualification ratio to 35.42%. But yeah, the stress test is mandatory in Canada. The good news is, for first-time home buyers, we could extend the amortization period to 30 years.
Okay.
Which is before it was an insured mortgage was up to 25 years.
So that's good news if you're...
That's good news because it gives a chance to people to qualify, to first-time home buyers to qualify. And if the interest rates start to go down, well, it's going to be a bit more easier as long as the price stays decent.
You mentioned in your Mortgage Minute, Martin, that even if you're above those ratios, you're not completely out of luck. So what are your options if you find yourself with 50% TDS?
Yeah, so before you go to a B lender, there are things that you can do. So if you bust the ratios, you can add a co-borrower, you can pay down some debts, you can make a bigger down payment. Obviously, if you go and get a co-borrower or you go and get a gift, it's because you're looking to offset the lack of revenue or offset the lack of a down payment that you have. Maybe you can buy a slightly cheaper home. And as Fred mentioned, you can also stretch out the amortization period to lower your monthly payments. If that fails, then we can take you to an alternative lenders, as we were talking about in the first segment. So we can take you to a B, which permits you sometimes to go up as much as to 55% in terms of those ratios.
I will say, Martin, you could go up to 65%.
It's pushing it.
Yeah,
But
if the loan to value is good, but you're pushing a little bit, but yes.
Yeah, because do you really want to go to 65? Because you also don't want to be house poor, right?
For sure.
You want to be able to buy a house, but you also want to not completely condemn your lifestyle. And in the fact that if you're so house poor, you can't even have people come over because you don't have any furniture in your house and you don't have any food in the fridge. you got a beautiful house, but you've stretched yourself out so far that there's no furniture, so you're going to be sitting on milk crates like back in university, and you'll be eating craft dinner. Nothing wrong with craft dinner, nothing wrong with milk crates, but you're buying a house because you want to have friends and family come over.
Now, when we do see that 65% LTV happen, would we say that that's typically for people who are possibly self-employed, and that 65% is not necessarily representative of the actual income? Therefore, the whole idea of being completely house poor doesn't necessarily align with the reality of the situation, Martin or Fred?
Yeah.
Well, okay, so that's a different. So we were talking about conventional, regular people that collect a paycheck, and we qualify them on their T4s, their letter of employments, and their pay stubs. So if you're self-employed and you don't declare a lot of income, you may have to go to a B. And during, like we mentioned before, those 12 of 24 months, maybe you have to sit down with your accountant and say, I need to declare more income to help myself qualify so I can bring my mortgage from a B to an A.
Well, or also, as LJ says, mentioned, for self-employed, we could take the last 12 months of bank statement and verbalizing an income based on the deposit that you receive in your monthly basis services.
Question for you, Martin. You had mentioned that one of the ways you could help with this would be to pay down some of that debt. Now, I know, for example, if you make a credit card payment, you pay off an entire credit card, it can take like a month or two for it to hit your credit report. Does that matter in this circumstance? LJ, I see your hand is up, actually.
No, we've done that in the past. As long as you show the proof of payment,
Okay.
they'll take that and accept it as, okay, it's been paid off and we're regulated.
Okay. Why does it take so long to hit Equifax and TransUnion? It's so long before your credit score changes.
It takes up to 3 months to
Yeah.
see things pop up. It's the system. Everything in the system needs to go through due process and the red
Yes.
tape and everything. And yeah,
Yeah. And even
Because Robin, when you're paying down debt, right, you're lowering your monthly obligations,
yes.
and so that all goes into the TDS ratio. So if you've got a little bit of money and you can pay down some of your debt, then you can offset and help your ratio qualify under that 44%.
I will say it feels really good when you can do that. When you see that credit card statement at zero balance every month, woo, feels nice.
Oh,
Yeah.
absolutely. Yeah.
Yeah, but the credit rating doesn't change because you just made a payment. It takes
No.
a bit of time.
Exactly.
Like
And
sometimes we have clients saying, "Hey, Fred, I just pay my card. I'm sure next month my credit will be good." No, your credit will be
No.
probably better, but
and not by that much.
No,
It
exactly.
goes up a
It
couple
takes a bit of
points.
time,
You know, even an inquiry, for example, when I bought my car, my credit score dropped by a few points, and it's been like 6 weeks, and it only now did it go back up to what it was before I purchased the vehicle. So it takes a while.
Because there's one thing, there's qualifying you. So
Yes.
if we're paying down some debt to qualify you, so we can get you under that magic 44%, and then there's also paying down debt or use of credit to then work on your credit score. Those are two kind of separate strategies. One is to really just to qualify you to get you under those two ratios that we need to with an A lender, and the other is to work on your credit score.
To find out more about what your lending options are, because as I'm sure you can tell, every situation is different, Fred and Martin are extremely capable of working with everybody on a case-by-case basis. You can get in touch with them by going to their website at fredandmartin.com. This is Under One Roof MTL on CJD 800. I'm Robin Flynn. That's LJ Aguinaga. That's Fred Pichette. And that is Martin Spalding. We are with you until 1 p.m. Before we get into discussing real estate as a retirement strategy, I promised JB and Pierrefonds that we would get to his question. He basically just wants to confirm his question that fixed rates are based on the bond market, whereas variable rates are based on the Bank of Canada's key interest rate. Is that correct? That is correct, right?
it is correct. 100% GB.
It is correct. Yeah.
Excellent. And I know Martin is our bond guy. He's always tracking the bond yields. So as soon as we know anything, you will know something, JB. You got to be listening to the show every Sunday from 12 to 1. And if ever you miss it, it is podcasted. You can get it online after the fact. All right. So let's talk about real estate as a retirement strategy. I know that this is something that is very common, very popular. People use usually their primary residence as a retirement strategy, but there are other ways that you can invest in real estate. So my question to you, LJ, as we kick off into this, should you prioritize buying a house for yourself first, or should you prioritize buying an investment property first?
this question comes down to what your goals are. If your goals are strictly financial, then buying an investment property is the first thing that needs to happen. if your goals are more anchored on your family living situation and setting down roots in a neighborhood and getting organized, then the family home needs to be the priority. So it really depends on you. I have clients who say, no, finances is really the only thing I care about right now. I want to be diversified. Awesome, let's do that. And other people, no, I need a place to live. I want to send my kid to X school. I need to be close to this and that. So we go down that road. So really, it is client dependent.
Could it be, LJ, a good idea to buy a duplex in this case, or a threeplex if you could afford it?
That sometimes is killing two birds with one stone, if you will. So I love that option. We consider that almost like an easy house hack, if you will, where you can occupy one unit. You can offset your costs from the rent that you're collecting from the other two units or other one unit. So that's 100% excellent idea, assuming you want to live in a neighborhood that has duplexes and triplexes, right? If we go out to the West Island, there's about 3 streets that have those types of properties, right? So that's the one thing you have to be considered.
So what can you do to actually build up your portfolio? You're making your first ever purchase of a duplex, a triplex, and things are going good. You're a couple years into it and you're like, hey, I really like this. I'd like to do it again. How do we do that?
So there's lots of different ways about going about that. The first thing I would say is, obviously, if you can start with a property where you can optimize it, you can create value. That will allow you to increase the value of the property relatively quickly, which will mean you'll have a bit more access to equity in there, which means that you'll be able to refinance that property, take out some of that equity and go buy another property. So rinse and repeat. The next thing you can do is you can look at a partnership with somebody. So you now have some experience, you now have some know-how. You might know other people who want to invest in the real estate market as well, but don't have that experience, and they're looking to partner with somebody who has that experience, and that's where you can come in. The next thing you can do is look at a different avenue. You can invest in a REIT possibly. So you can invest in a real estate investment trust, which is a type of stock, if you will. And you can obviously invest a much smaller amount and to get into one of those at the same time as well. So
okay, what is a REIT? Tell me more about this.
Sure. A REIT, a real estate investment trust, is effectively a company that trades on the stock market that only owns real estate, for the most part. So they basically are a company that is a holding company that goes out there and buys different types of real estate, whether it's commercial, office, retail, residential, single family, you name it. And their gains and their returns are based on how their portfolio is doing. And you're effectively buying a piece of that company.
Interesting. Okay, that's very, very cool. When's the best time to cash out? If you're using this as your retirement strategy, presumably you want to cash out when you retire so that you can withdraw some of that equity, right?
I mean, to be honest, the best time is really to never cash out, right? Because if you set it up properly and if you can buy the properties early enough to have them paid off or almost paid off at the time of your retirement, then you just want to live off of the income of the rent roll. So you have the rents coming in, you pay off the taxes, the insurance, maintenance, etc., and then whatever's left over, which, I mean, could be $50,000, $60,000, $70,000 a year, is a great salary to be living off of at that point in time. And if you do this with a couple of different properties, all of a sudden you could have 100, 200, 300 grand coming in. So that is the best way of going about it. And then eventually you can pass those properties along to your heirs, if you will, right, and go about it that way.
Martin, I want to loop you into the discussion because you don't necessarily have to have a portfolio of properties in order to use real estate as your retirement strategy, right? You can withdraw equity from your primary residence. You can take out a reverse mortgage. There are other options, right, Martin?
Yeah, you know what? It's funny. I was going to ask LG what his thoughts are on using the equity in your principal residence. Is that something that's wise? In the sense that I always felt that my principal residence was untouchable. So no matter where my investments went, I knew that I hadn't tapped into the equity in my principal residence. And so I know a lot of people use their principal residence's equity to purchase the next property, then to use that equity to buy another property. But I wanted to hear, LJ, is ton château fort is your principal residence? Should you be using the equity in that residence to purchase other properties? Because if your other investments go sideways, you always want to be sitting in your nut, as they say.
Well, I think that really depends on your tolerance to risk, right? You've made it very clear that you have a low tolerance to risk, and therefore you want to have that safety net to protect you. And I completely respect that, and I have lots of clients who feel that same way, and I have other clients, and including myself, who say, we're young right now, it's time to take the risks and potentially make the mistakes, and we'll have time to rebuild if we have to, if it goes down that road. But let's go all in and let's take advantage of these risks, because if we can do things right along the way here, we're going to have a lot of time for this to compound and really grow into some pretty interesting returns. So that's been my goal. That's why I've been buying properties all over the place, because I know that by the time I reach retirement age, they're pretty much all going to be paid off. They're going to have $100,000 mortgages left on them. So at that point, we're going to be living off of some pretty interesting cash flow.
How risky?
Robin, I don't know if you heard that, but he mentioned that I'm conservative and I'm older.
I was just going to blow right past that, Martin.
I caught it. Thanks, LJ.
How risky is it to invest in real estate as your retirement strategy? Because I think from what I've learned doing the show with you guys, real estate is a relatively safe investment, and you don't have to worry about an Enron situation.
I don't think there's much risk when you see the increase of the rents going on.
Property values just
and
always
property
go
value
up.
as well.
Again, there can be correction in the market, right? 2 years ago, we saw a 10% drop in valuations across the board. If you needed to sell in that day, you'd be pretty frustrated that you lost 10% from one day to the next. It wasn't even one day. It was over the course of the interest rate increases that we saw over a 6-month period. But nevertheless, I see real estate as a safe investment, right? If you have some experience, if you're comfortable with it, no problem. Like anything, there's risks. Of course, you can buy a lemon. If you're not well advised, if you don't have the right team in place, if you don't know what you're doing and you don't go out to seek advice, then 100% you can make mistakes. Anyone can make mistakes. You can get a bad tenant even. You might have no rent for 3 months because you're dealing with it at the rental board. Like, things can go wrong. This isn't all roses and butterflies, but overall, in the grand scheme of things, if we're talking about a safe, long-term investment that they're not making any more land around us, people need a place to live, there's really limited downside risk.
And if you want to make sure that it's passive and that you have to do as little work as possible, that's where property managers come in, right?
Call the Plex Doctor.
Exactly. So if you're ready to purchase a multiplex and let that passive income fund your retirement, give the Plex Doctor a call, 514-709-6397. You can also visit their website at plexdr.com. This is Under One Roof MTL on CJD 800. I'm Robin, that's LJ, that's Fred, that's Martin. We are with you until 1 p.m. Before we get to the answer of our trivia question of the week, let's go to our property of the week. What do you have for us this week, LJ?
Are you looking for comfort, location, and lifestyle?
Yes.
Welcome to 8155 Boulevard Le Duc, Unit 403, a sun-filled corner condo just minutes from Quartier 1030 and the new REM. This stunning 2-bedroom, 2-bathroom unit features unobstructed views, a huge private balcony, 2 garage spots, and 2 lockers. All in a building with a rooftop terrace, outdoor pool, and fully equipped gym. Live steps away from shops, restaurants, entertainment, and enjoy easy highway access, or hop on the REM for a quick ride downtown. Listed at just $525,000, stop by our open house today from 2 to 4 p.m. Alexandra will be there to greet you. Also, we're hosting a few other open houses, also from 2 to 4 p.m. We've got 775 Rue Osborne in Verdun, a great 2-bedroom condo that's listed at $425,000. Nikita will be there today. And at 5224 to 5226 Rue Clark in the Plateau, we've got an awesome duplex with a 2-car garage in the back in the Plateau. I said 2-car garage in the Plateau. Yeah, that was not a mistake. We're listed at $949,000 there, and Julie will be there to receive you.
If you end up in that Brassard unit on Le Duc, I can highly recommend Pizzeria Sofia in this town. I went there with a friend for my birthday a few weeks ago. It was excellent. So
It is
really, really
excellent
good.
there.
Excellent food. Okay, trivia question of the week. You are going to win some delicious cookies. Cookies are on the line from Felix and Norton. Our question this week, what is the minimum amount of equity required to refinance your mortgage in Canada? The correct answer came in from Dave, who correctly said 20%. You need 20% equity in your home in order to refinance. Is there, you kind of teased a possible maximum earlier. What does that mean?
No, but technically you could, in Canada, you're allowed to refine your property as long as you qualify up to 80% of the value.
Okay.
And you could go up to 85-90% when you do a buyout spousal.
Oh, okay. So in the
That's also a
instance of a
possibility.
divorce or end of common law.
Yeah,
Gotcha.
yeah. But if you just need to pay down debts, it's up to 80%.
Okay, very, very cool. Guys, we learned a lot on the show this week, as we always do. I personally learned that we kind of need to wait and see before we can make any further predictions on what the Bank of Canada is going to do with interest rates. We have a new prime minister in Canada, so we need to see what he's going to do. He's got to present a budget. He's got to present his new cabinet. We don't know what Donald Trump is going to do next hour what he's going to say on Truth Social. So we need to pay attention to what happens there. The next announcement isn't until June, I believe.
It's
so
June 2nd.
We've got some time before the next one. Also learned that you should pay down if and when you can your debt to keep your TDS and GDS as low as possible. 39 and 44. Those are the magic numbers when it comes to qualifying for a mortgage. So thank you, Martin, for teaching me a little bit about TDS and GDS. And we also learned that real estate can be a great investment and part of your retirement strategy if it's done properly, as long as you do your due diligence and you consult with experts like LJ Aguinaga. He's the guy to help you out as you make this huge investment to purchase real estate. Is this something that is becoming more and more common, by the way, LJ? Like, are more people choosing real estate as a retirement strategy as opposed to playing the markets?
I think it depends. I mean, there's definitely a lot of people who are getting into real estate. I think it's getting a lot of activity, limelight kind of shared on it, if you will. But I don't know that it's necessarily more. I mean,
well, usually you have the two kind of people: the one who believe in real estate only, and the other one is going with the stocks. It's rare that I see someone who say, "Oh, I have a few property and I have a lot of stocks, and I play with both." It's usually one or the other. I have some many clients old school, and they believe in real estate more than the stocks.
Hey, LJ, when's your next meetup?
Our next meetup is the second Tuesday of every month, so it's going to be on the 13th.
And how do people register, or how do people just show up? How do people go about it if they want to learn more about investing?
You simply go to the group on meetup.com. It's Montreal Real Estate, and you can register on there, and then you can come and attend. There's no cost. We'd be happy to see you.
Awesome. And this happens at the WeWork location?
At the WeWork location in front of the Bell Center downtown, exactly.
Awesome.
Actually, Fred and I have 2 new clients that were just in the process of pre-qualifying them, and I talked about your meetups, and both of them want to come.
Boom.
There you go.
Yeah.
Amazing. If you missed anything, by the way, you can check out this show in its entirety. We're on iHeartRadio, Spotify, Apple, wherever you get your podcasts. There was some really good stuff about total debt service and gross debt service in the second segment of the show. If you missed it, you definitely want to go look up the podcast. That is pretty much it for us for this week. We will be back next Sunday at noon right here on CJD 800. In the meantime, to learn more about us, the show, you can visit our website at underoneroofmtl.com. You can also reach out to LJ, Fred, and Martin individually. LJ, where do people go to get in touch with you?
Best thing to do is go to our website, ljrealties.com, and then you can also call me or text me anytime, 514-500-4040. If you need any help with your property management, we'd be more than happy to give you help with that. Stop by plexdr.com or reach out to 514-709-6397.
Fred, Martin, where do people go to get in touch with you?
So if you're a first-time home buyer, if you're a buyer and you want to be pre-qualified, you're looking to refinance, you're looking for a reverse mortgage, you go to fredmartin.com. You can book us directly to the website. Our phone numbers and email addresses are there. So go to fredmartin.com. And Fred, where do we go?
fredandmartin.com.
I think it was fredandmartin.com, if I'm not mistaken. Thank you so much for listening to the show. Thank you to Dean on the board for keeping us on track. For LJ, Fred, and Martin, I'm Robin. Have a wonderful day.